Okay.
So a lot of the DC participants are getting access. They may not know that, but they're still getting the same access as they were on the pension side.
Jonathan, you're the CEO and founder of DCALTA. I want to say thank you so much for taking the time to chat with us today.
Thanks for having me.
So just to get some background, can you talk a little bit about DCALTA, why you founded it, and what it does?
DCALTA, it stands for the Defined Contribution Alternatives Association. So at the time, back in 2015 when I started it, there never existed an association that bridges the gap between alts companies and firms and asset managers and the DC industry. So the DC industry is the defined contribution industry. So we wanted to create an association that provided not only resources for both, but so that they both can talk the same language. We're also, we're focused on three pillars: advocacy, research, and education. Okay. So the advocacy part's is very interesting. So right now, we have a bill that's introduced, we're trying to get bipartisan support for, to change ERISA, which is the language that governs defined contribution plans that are qualified. And in that language, we're trying to lay out exactly what type of investments should be available. Okay. And alternatives are certainly one of them.
What percentage of a DC plan historically would have been allocated towards what we call alternative investments? Where are we today? Where do you think we should be?
Great question. So I'd say 0% were allocated to alternatives.
It was predominantly 60-40. That would be the portfolio.
It would be 60-40 stocks to bonds, traditional, long only. So if you take an employee of, let's say, a county or a state where they have access to a DC plan, the defined benefit plan that covers them from the pension side is the portfolio allocation is completely different. And that's pretty much the main reason why I founded DCALTA, because we wanted the same type, because a DC participant, they want to retire at 65 or they could work till 70, and it was important for them to have the same types of investments and opportunity set that their DB plan takes access to.
Now I just want to ask about the DB and DC plans. Obviously with defined benefit, the liabilities are much more burdensome. So with that, how do you give a longevity to an alternative investment? Like, are there liquidity constraints? Because when I think about insurance companies, I think about asset liability matching. It's like, okay, my liabilities is X 10 years out, X 20 years out, X 30 years out. Yeah. So I can buy 10-year bonds and 20-year bonds and asset liability match. And then I've got equities, which obviously are very short term in nature. But when it comes to alternative investments, where do they sit along that time horizon?
DCALTA, how we look at alternatives is we don't think that they should be standalone investments on a menu. So an employee is not going to have the ability to invest directly, let's say, into a private equity fund. We may get there in 10 years or 15 years, but at this point we believe that it should be within a multi-asset portfolio like a target date fund.
Okay, I see.
So typically what you'll see in a target date fund is there's a glide path based on age, or it could be based on risk, and alternatives can serve as a complement to that. What we're seeing now is roughly about 10 to 20% allocations to different types of private equity, could be private or direct real estate, and then even debt is also involved in there.
Yeah, because I remember when I was back in the world of finance, and the 401k plan was with Fidelity. We had Fidelity 2035, Fidelity 2045, and you basically just picked your year and left it to that.
And you bring up a good point, because there's one of our members is a provider, but they're also an asset manager, and they're a record keeper.
Right.
And they've put alternatives in their target date funds, and they went through these same issues as first, how much, so what should the allocation be, and then what should the allocation be within the alt sleeve itself. And they had decided it would be roughly 30% each into private debt, private equity, and real estate. So
10 years ago, the allocation to alternative investments was basically zero. Now it's minimal.
It's still minimal, yes.
Like 1%?
I'd say more at 3%. If we measure it by number of plans, it's certainly going to be lower. But if we look at it from an AUM or assets under management, it's certainly probably about 3 to 4%. There's been a lot of investment in real estate, and there's also been a lot of.
Do you mean direct real estate or real estate
direct?
funds?
Yeah,
So
direct.
Actually owning property.
Correct.
Okay.
Or these are funds that will then invest in properties.
Okay.
What we're seeing in the marketplace, if you look at it just from an alt standpoint, the large corporate plans are starting to take interest in this because a lot of the CIOs, they also manage, they're used to alternatives in their defined benefit plans. So they're starting to see that their participants need pension-like returns. So you talked about longevity and things like that. So they're getting into this movement. And then we're also seeing a big shift into the public sector, where governments like large states or large counties even, what they're doing is they're unitizing their defined benefit plan and then offering that as an option within their DC plan. Okay. So a lot of the DC participants are getting access. They may not know that, but they're still getting the same access as they were on the pension side.
Just to enlighten me, I'm not so much of an expert in this world, but when it comes to private equity and venture capitalist firms, and I know you mentioned that you didn't think there was that much allocation going directly into these funds, but are more of these funds becoming SEC regulated, and does that make it easier for these funds to invest in those companies?
We're seeing product being developed that may be SEC regulated product. We're also seeing the other side of that, where custom target date funds that may be structured as commingled trusts are not. So we're seeing kind of both. More the retail or high net worth, yes, the SEC regulated products would certainly make more sense if they were looking at it for an immediate need or to develop and fill a need. The larger space is a little different, where a large corporation that has the assets and the internal investment team and the savviness, or they're using great consultants that recognize diversification, then those are going to structure it a little bit differently. They'll start using CITs and structure it different. So we're seeing both, and it's kind of it's interesting because it's being driven from the lower retail market and then from the larger institutional market. And it seems that's where we are right now. Is it's getting closer.
Sorry, what do you mean by it's driven by both ends? Do you mean lower retail, there's just more demand or appetite for this?
Right, so individuals, I don't necessarily mean a hierarchy, but so that you have retail investors and then you have institutional, and the way the products are being developed are kind of both from the retail level and then at the institutional level, and we're starting to see them merge a little bit with more alts. So
I guess the job of the regulator is really to try and protect policyholders. I mean, this is their life savings. The 60-40 portfolios had a really rough time recently, particularly this year. Does that poor performance going to, you think, accelerate funds moving into the alternative world?
I would hope.
Yeah.
I would hope. Not necessarily in the short term. I think you bring up a really good point of diversification, risk mitigation, hedge funds. So I think all of these types of investments are important in a long-term portfolio. I think when you bring up policy, I think the SEC and the DOL have done a very good job at trying to communicate with each other and take a better look at transparency and how products and underlying investments should be offered. But when you wrap in our world specifically, in the DC world, the fiduciaries have to adhere to a fiduciary standard, right? So there's a whole additional layer of that due diligence that has to take place. Otherwise, these corporations, can face litigation risk, right? For doing something like crypto or anything that may be out of your traditional type of investment. So.
Well, seeing as you bring up the topic of crypto, let me ask you about digital assets. Are they an asset that's just too far on the horizon when it comes to defined contribution pension plans, or are we getting closer to a point where they could be a meaningful part of them?
So many good questions. So I'll frame it this way. So we have a member that's a fairly new member over the last couple of months, and they are an innovator in that space. they were able to form a relationship with one of the cryptocurrency custodians.
Okay.
And they believe strongly that a 5% allocation to crypto, which is their max that they would allow, should be available to plans, 401k plans, and any type of DC plan. And it would be done through a self-directed brokerage window.
Okay.
Traditionally, that self-directed brokerage window is not something that the plan fiduciary needed to monitor. But recently, there's...
So who is the plan fiduciary? Like, who says that 5% is a comfortable level? Why not 2? Why not 10?
So that's being done at the firm, the provider level,
Okay.
as their differentiator, as their, after all the research that they've done, that the 5% allocation is where they felt a max should be for this particular company. The fiduciary is the one that then hires them to go ahead and offer this as an option. There's also ways that once you get in, I didn't want to go off on a tangent with the self-directed option, but there's a lot of room and flexibility in that. But traditionally, the fiduciary, it could be an investment committee, it could be a single person, it could be on the HR side, it could be on the finance side, but they're the ones that have the risk for the types of investments that have to be monitored.
It's difficult to predict the future, obviously. But if you look into a bit more of a crystal ball and see how, let's just take the US, let's just say how the US market will be asset allocating in 6 to 12 months' time. How do you feel the landscape will have changed over the next year?
I think that target date funds, and I keep referring back to your multi-asset type of structures, that we're going to start to see larger allocations to real estate, to private equity, to private debt. I think eventually, maybe in a 5-year time frame, we're going to start to see hedge funds, if not 3 years from now. And a lot of it depends on who's managing that target date fund or multi-asset portfolio. Is it, are there consultants that are hired to manage certain aspects of it? Who's doing the glide path? But hedge funds could be a good source to certainly mitigate risk.
Do you feel that the retirement age needs to change? Do we need to kind of rethink the way we are saving for our future as people are living longer and longer?
I've never been asked that question. And I think it should be looked at, especially if you're using, retirement income or using anything that may be insurance-based or annuity-based. That certainly age is going to have a major factor on that. From the person offering or firm offering the product to the one that would actually buy it at the participant level. I do think that you would hope with Social Security, that is clearly an issue with 2035 is the magic year when it may not exist or be able to fund everyone. So I think portfolio diversification, allocation, age certainly is a primary factor. The magic number for most people, I think, it has been increasing, sadly. And I have no problem working until I'm 75, if I'm still breathing. But I do think that the age is certainly getting older for these people.
Yeah.
So.
I was chatting to someone before, and they said that, I can't remember the exact quote, but it was an alarmingly large number of companies within the New York area didn't have 401k plans. Now that could be because they're single person LLCs, because there's a lot of entrepreneurship, could be their startups, the gig economy. That just means less, and they're obviously, it's a large financial burden having a 401k plan for your employees.
Definitely.
What do you think about that trend? Do you see that trend continuing? Is it a concern at all?
I think the number of DC plans is only going to grow, and
Okay.
I think the size of the DC space, and if you include IRAs, I think it's probably in the 10 trillion space. And that's I think as we start to see mergers and acquisitions in the large corporate space, that a lot of the defined benefit, traditional pensions are going to go sadly away, and that certainly promotes the DC as a structure for retirees and participants. And I do think maybe not necessarily the number of DC plans, but I think in general the DC space is only going to get larger, and that's globally as well.
Yeah.
So like in the UK and Australia, where their DC systems are very strong, and their primary form of savings. So DB I think will be less, DC is certainly going to grow.
And lastly, you mentioned a few other countries. Is there any other countries where you admire the kind of pension system they've got going, and who would they be?
In 2015, when I started DCALTA, I started looking at different systems outside, and Australia with the superannuation system was certainly one that I looked at and admired.
How does that work, the superannuation?
Australia provides, I think, a 9% contribution, and then the member can decide which super that they would want to invest in. It used to be industry-wide, where supers would have be based on industry, but there's been a lot of movement in that now, where there's a lot more choice for members to choose where they put their 9%. I also think they're going to grow that to 12% over time from Australia, and then I think the member is also able to participate in that and contribute. There's been a lot of consolidation in the supers where, and it goes back to the point of allocation again, and I'll always point to allocation, but it's something where the consolidation was taking place because the smaller supers, the funds that are being offered, some of them weren't investing in alternatives like private equity and real estate, and when they started looking at the performance and the returns of the larger supers that had access, economies of scale, they were able to invest in different types of alternatives, and the performance certainly was clearly better for the largers, and I think we saw consolidation up to the larger systems. They've been investing in alts for decades.
Yeah. Well, Jonathan, it sounds like it's a really interesting time for the DC space, and I want to say thank you very much for your time. It's been great chatting with you.
Thank you so much.